let's take it from here then. I welcome you. And today is, in fact, a very, very special day. After some comments yesterday from Fed President Williams, who, who caused some higher volatility, let's say, some turmoils, which resulted in that. So to give you an idea of what just happened, we will talk about the details a little later. That was just a personal thing, I will tell you now. So I prepared my research for today, weekly market outlook and everything already yesterday in the evening. So far, there was no big things happening, let's say. Around, 10:30 Eastern time, Eastern European time, so Cypriotic time, respectively. It was 8:30 London then in this case. I was looking at the quotes, and I was just seeing that gold shot higher and dollar yen just collapsed and pushed lower below 107.50. And the reason was due to the comments from Williams. We will look into some uber dovish comments, which shortly after were just put in perspective, and where they said, well, it was only based on research and only academic. It was nothing which relates to any upcoming rate decision from the Fed or something. So this is especially what we want to look at then today. Before we start, as usual, here the risk disclaimer. So just let me probably drive this a little lower, probably here, so that you can read the first 3 sentences. The whole risk disclaimer can be found on the website from Admiral Markets. So trading with financial instruments offered by Admiral carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral. And then we want to here have a look at nevertheless something special. It's the so-called ESMA decision. We had a look at this already several times in the past, and we will continue to do so even after 1 year now, after this ESMA decision was put in place. It's now a differentiation between retail clients and professional clients. And there, something very important happened, and now I put it back here. There's now this differentiation affecting mainly the leverage which is offered to retail clients, which has now a maximum of 1 to 30 on Forex majors like EURUSD or $JPY, and also 1 to 20 for other currency pairs, so-called minors, GBP CAD, for example, or GBP Australian dollar or Australian dollar JPY, and also on CFDs on indices like the DAX 30, but also gold, for example. So now, the differentiation between retail clients and professional clients comes into play at the moment where certain criteria are met by people. The criteria, all details can be found on the website from Admiral. If you plan to reclassify as a professional client, feel free to find out whether this suits your overall appearance, let's say, as a client, and your experience in the financial sector, your financial situation, your experience in trading in general. But if you are classified as a professional client, you are not affected by this leverage restriction, but you can continue to trade with a leverage of up to 1 to 500. And nevertheless, there's something very interesting in regards to this ESMA decision for retail clients. There's now an unlimited protection against negative balances if you're classified as a retail client. As a professional client, this is not necessarily the case, but in case of Admiral Markets, they have an offer which makes it possible to be protected up to £50,000 against negative balances. And therefore, also, please feel free to reach out to Admiral directly, to their customer support for further questions. Usually, I used to say, this is the face to the voice you're currently listening to. Well, you can now see it via the webcam, so I have to think about saying something different here at this moment. What's probably interesting of in regards to my person is where I'm located. So I'm located in Germany, in Berlin, Germany. Admiral has, by the way, also an office here in Berlin, in Germany. And in Germany, we usually refer to Admiral Markets as the so-called DAX expert, with a very, very competitive offering in regards to the DAX 30, especially with a typical spread of 0.8. In fact, there's also an offering, Admiral Prime, it's called Admiral Prime, where you have a typical spread of 0.2, and you pay a commission on top of that. This is probably especially interesting for short-term traders, scalpers, So traders which are dependent on a very, very tight spread. Further infos also, please feel free to find them on the website from Admiral. On top of that, there's also a very competitive offering in regards to FX. And yeah, so it's definitely worth to give it a deeper look and get an idea from the offering from Admiral. I already mentioned it, One World Global Offers. So in regards to Admiral Markets, they have plenty of offices around the globe. One in Germany, Berlin, as I already said, but also, for example, in Australia. There it's Admiral Markets PDY here at the bottom with a different license in this case, so licensed, regulated around the globe, and with what this could mean for your trading. Also, please feel free to reach out to the website, contact Admiral directly. And then we want to give the contact details. I talk about contacting Admiral directly, so you can find those details here. Now, let's place it probably here. You can see the email address. Feel free to reach out to Admiral. And then we want to now dig into the agenda for today and have an idea of what are the key economic events in the coming week of trading we will look at. Surely we will have a look at what to expect from the ECB next Thursday. So before we have the Fed decision on the 31st of July, we have next Thursday on the 25th already the rate decision from the ECB. All in all, I don't think that there will be much of news around the rate level, but nevertheless, it's probably a meeting where market participants are prepared in regards to further monetary stimulus, respectively, probably a rate cut already taking place then after the summer break in September. There's some hints to that after some comments from ECB officials, ECB board members, and this is surely the main event then in the upcoming week of trading. On top of that, also, in addition, speculation in regards to yields we will look at here after the comments yesterday from New York Fed President Williams. And surely, we want to answer the question, what's the current bias in the FX, equity, and commodity markets? And also, we want to see whether we can probably spot any arising trading opportunities based on that. And yeah, so that's it from here. Let's now switch over to the markets. We can here see that the DAX currently is under pressure and is attacking potentially the region around 12,180, 12,200 again. Let me just switch over to the hourly chart probably. So it's in my opinion a little difficult to say. One second, by the way. Let me just close that here. So it's a little difficult to say where this pressure comes from, even though I have to say that the overall structure, which developed here over the last days, is clearly short. So there's a sequence of falling highs and falling lows, which can be spotted since the 4th, 5th of July, since the beginning of the week. And after we failed to make it back above 12,430, 12,470 points here, this is this red box, and fell below 12,300 points, which was, by the way, initiated by a weakness in US equities. We can clearly say that the overall advantage right now is to be found on the downside, clearly found on the downside. And the sequence would be forthwritten once we now push below the lows, which were marked here on Wednesday in the evening. Oh, I'm sorry, no, it was yesterday in the morning. It was Wednesday in the evening. We attacked 12,300 and then we broke lower overnight. And yesterday we pushed as low as 12,200 points. And as you can see here, if we zoom out a little, you can see there's now a sequence forming of falling highs and falling lows, which would be forthwritten once we push below that level. This comes as a surprise at first glance, at least. Because one would say, especially after what I just said around the ECB and this potential monetary stimulus, which will be brought into play from the ECB then next week, and potential rate cuts into the negative territory at the September meeting, one would probably say that more stimulus, more liquidity is usually positive for equities. The same is true for US equities in this regard. So when looking, for example, at the developments here around the Fed yesterday especially, it's more liquidity brought into play, and usually what you expect is markets to react bullish on that. What's interesting is that we've seen a short-term bullish reaction here in the morning, but the DAX failed to take on further momentum on the upside. Instead, it currently, obviously drops lower. And the main reason for that can be found in some thoughts I've presented over the last weeks already. I said I'm not really sure whether any more liquidity or monetary stimulus from central banks is capable of pushing equities really higher, due to the reason or the driver for this dovish bias, let's say, from central banks. And so from a fundamental perspective, things are obviously turning bad more and more. It's not only true for Europe and Germany here in this regards. Remember the ZEW, for example, the sentiment indicator, which was published on Tuesday, which came in again below expectation. But it's also true for several data from the US. Okay, we had some solid NFP data. Nevertheless, there's more and more signs, especially when it comes to purchasing in the indices, respectively purchasing manager indices, ISM, for example, manufacturing, non-manufacturing, all these data sets, which point to a slowing economic growth, respectively, more and more to fears that probably there's a recession forming on the horizon. And this is especially true also when looking at yields and the inversion of the yield curve from 2 to 10 years, and in this context. And with all this in mind, any signs of monetary stimulus from central banks is probably already an anticipation of an economic downturn, which should be expected. And this is definitely not an environment in which you expect equities to gain momentum, because earnings will probably be affected in a negative way, and the growth outlook also for companies will be negatively affected. And this is something which can also be found here in several comments from yesterday. So first of all, let's have a look. Where do we start? Probably we start here. We start probably here. This is an article which is already summing things really well up. It's from Zero Hedge, which is summing up what just happened yesterday. So, and what I already mentioned at the beginning. So in a speech titled "Living Life Near the ZILP and Why Fat Williams suggested the lesson learned is to take swift action, and the market appears to have taken that as uber dovish, dumping dollar, bidding for bonds and stocks." So that was the development I already mentioned at the beginning. So what he here, for example, mentions is that currently he estimates the neutral rates in US around 0.5%. This is very interesting because last year, some of you probably recall the starting point of the turbulences in equities and this high volatile fourth quarter in 2018. That was the starting point, found the starting point, and some comments from Fed Powell, the Fed chairman Powell, who said that we are still way below neutral, which suggested that there will be very likely more, or market participants should expect more rate hikes to come from the Fed. And back then, we remember we were at 200 to 225 basis points, if I'm not mistaken. So if we are well below neutral, that means that probably this neutral level can be found somewhere in the region around 3% or something. Williams now is saying that this is crucial, or definitely way lower at 0.5. In addition to that, he also adds, for example, that investors see low inflation readings as a new normal in this regard. And then he comes up with something which was then the main driver for not only the push lower in yields, but also the push higher in gold, for example, and also the push lower in dollar JPY. He says that here, there's first to take swift action when faced with adverse economic conditions. This is something, by the way, which was also said yesterday from someone we nevertheless expected from. It was from a board member. It's his name is Clarida. I'm sorry, his or her? Oh, boy. One second. I think, let me just see. Is it Miss Clarida? Hopefully she'll never see that. If it's she. One second, please. But I'm somehow of the opinion that it's she. 1 second. Now it takes a little. 1 second. I'll be there in a few. Before we look, well, we wait here. So this is no. By the way, yeah. Let me probably first of all see. No, it's Richard. It's Richard Clarida. Perfect. Okay, it's Richard Clarida. Okay. So his remarks, everything fine. He also said something very similar to that, saying that an anticipation is necessary. Let me just see. Is it probably no? It's not. It's not mentioned here within this article, but we'll see this in a few seconds then. So that there is some obviously a need to anticipate an economic downturn, and probably already start to cut rates before the economic is negatively affected in any way. And this is what was interpreted as uber dovish was here. Second, keep interest rates lower for longer. So this was the reason, the main driver potentially why those July rate cut expectation pushed then here to 70%. And significantly higher than yesterday. So therefore, let's have a look here at the 50 basis point expectation in the Fed Watch tool. As you can see here, now it's down to 45% again. That's also probably likely driven by some comments which were just made by James Bullard, who said that he sees no need for a 50 basis point rate cut. Still no need. And usually Bullard is also known to be more dovish in his remarks. So this is also something which does not come as a surprise, because we remember that was shortly before the non-farm payrolls at the beginning. We had this in a weekly market outlook here mentioned also. These comments were meant from him in an interview with Bloomberg already. Still, it's capable of pushing those expectations a little lower and below 50% again. Still, yesterday, this push to 70% was the main driver for the US dollar weakness, respectively gold pushing higher and yields being pushed lower. And now let me just probably take this out here also. And then overnight, we got this. We got a short note that the speech today by Williams was academic and based on research and was not about potential policy actions at the upcoming FOMC meeting. The only problem with that is that Williams is, again, the New York Fed chief, the New York Fed president, someone you listen to. And in the current very sensitive environment, you should expect here markets to react in some way, obviously. And so it's very difficult now to really see that this was only academic and only based on research, but probably is already trying to prepare markets for a very dovish stance from the Fed in the months to come here, in anticipation of a potential downturn in the economy. And let me just see now. I hope that that this opens now. Yeah, there we have it. Let me just scroll down a little. So this is my Twitter account, and there are the comments here from Clarida. He says you don't want to wait until data turns decisively. But this is something, again, this is something you expect then from a dove like Clarida, in comparison to someone who is more considered to be neutral, in my opinion. Who the Fed chairman or Fed New York chairman Williams is then in this regard. So, okay, this is the overall picture we have here. And it's very interesting to see that based on these dovish comments and the expectation also around a very dovish ECB, that the market can't really profit from that. And the DAX here is pushed lower now. The main question we have is, will there be further momentum on the downside? What we can clearly spot is when looking, for example, at the S&P, for example, here, is that we are still in a low volatile market environment. So volatility stays subdued here. But I, to some extent, could imagine the market probably give it another try to retest the region here around 2,960 points. This is not a massive downturn, which should be expected, or a big corrective move. But, and this is the thing, when looking at the DAX, which is positively correlated to the to the US equity market, and in this case the S&P 500, I could imagine that there will probably another attempt to break towards or below 12,200 points, in my opinion. So with this said, especially when we're looking at the daily chart, you can see that then there's a crucial support region coming into play. I see around 12,150 points. So even though we should expect ECB to come out quite dovish next week, obviously it's not capable of turning things around for the DAX, and there's potential downside potential, which is, in my opinion, a sign of weakness, and why long engagements should be only carefully taken, especially if we break below 12,150 points. In this regard, by the way, I just see a question here. Tell us, please, about the indicators you use in your analysis. In fact, when I analyze the markets, I do this mainly based on price action. So I identify, in fact, only higher highs, high lows to get an idea of a trend structure, in this case, an uptrend, respectively lower highs and lower lows for a downtrend. The line you can see here, this moving average in this regard, this is a 200 simple moving average. This is only for to have an idea of where do we stand right now, and are we overall long or short. And once we broke lower, as you can see here, for example, in the past, that was in the fourth quarter 2000. No, in fact, no, it wasn't the fourth. It was already the third. In July, once we broke below that, the overall uptrend here in the DAX was broken, and then we took on further momentum, which accelerated quite strongly once also U.S. equities came under pressure. And this does not change. Also, when it comes to my trading, for example, when looking at my 5-minute chart, for example, which I usually take for my trading decisions, the thing is that I prefer to use an EMA 50 in this case. It's an exponential moving average 50 on a 5-minute time frame. So this is the DAX, by the way, on 5-minute. Let me just include this here. And I use this as an trend filter, which means if I identify my open range, as I usually do, I look at the high-low in a predefined time window, time frame, which is usually between 8 to 9:05 a.m. German time, and then I say I trade only breaks on the upside of this range. If we trade above this, in this case blue line, the EMA, respectively, I only trade breaks on the downside if we trade below. And this is how I use indicators, and usually I don't use any indicators like let's say MACD or RSI or something. I sometimes bring it into play. For example, here on the hourly chart, probably some remember I'm bringing in such tendencies to a bearish divergence, for example. But this is only for illustration purposes, how to use it, how you could use it in your trading. But it's not that I trade based on that. So it's usually an indication, a bullish divergence showing that probably a market is losing some momentum on the downside and is probably prone to see a corrective move higher. On the other hand, if we see a bearish divergence, if I'm long, I start to trail my stop more aggressively to make sure that this first indication, sign of diminishing momentum, in this case on the upside in direction of my trade, is so it's a warning sign, let's say. Yeah, it's a warning sign, and you start to trail more aggressively with the stop. But it's not that I trade based on that, but I need a clarification, or I need a clear sign from the market that a structure, trend structure in this case, so a sequence of falling highs and falling lows, is clearly broken to take long engagements, and the other way around. Yeah, I just hope that this answers the question. And you can already, by the way, also see here what's necessary right now to brighten the technical picture on the hourly chart. Therefore, we need to, in this case, push above 12,350 points here. That said, further gains are likely then to give us potential up to 12,430, 470 points. But, and this is the thing, as long as we do not make it above today's highs around 12,350, we should be very, very careful, or bulls should be careful, because we then have a chance still a chance, where higher likelihood that there will be another attempt to attack and probably also break below 12,150 points, the crucial level on the daily chart, which could then trigger further weakness down to 12,000 and below that. So yeah, that's it on the DAX. Let's just have a look here on the Euro USD in this case. So here the picture hasn't changed. After this remark that it was purely academic and only based on research, these comments from Williams, we saw that the euro gave back most of its gains here. Yesterday, into these comments and the weakness of the US dollar, the euro pushed as high as 1280. 113, a level which I already mentioned several times in my research before also, where I said, okay, if we make it back above that level, further gains are likely, even though I don't like to be long the euro in the current market environment, based on my opinion that the ECB will come out quite dovish next week on Thursday. And now we can see that this is also probably and most likely the reason why we're giving back most of these gains we made yesterday here after these uber dovish interpreted comments from Williams in this case. Let's have a look at $JPY. That's probably also very interesting to see here. I already said this, and you can, I'm not sure if you can see that here, but there's a thin green line. It's a dotted line, and then I have a reason to dot it because I don't think that this is such a crucial level on the overall daily chart or daily time frame, but it's on the lower time frames. It's relevant. If you have a look here, well, I'll probably take H4. You can see it here. There were two occasions when the market tested this region and then shot higher and tried to regain, bulls tried to regain control here. They failed in the daily chart by sustainably recapturing 109, and now after we pushed lower after the comments from Williams yesterday, that was the first clear sign that now further losses are very, very likely. The thing is that after these comments were put in perspective, the whole picture completely changed again, and now we find ourselves in an environment in which we should be a little skeptical, let's say, about overly, or let's see, skeptical, or don't be too optimistic to expect high volatility in the days to come, especially in such a yield-sensitive US 10-year yield-sensitive currency pair like $JPY. The reason for that is that tomorrow on the 20th, the so-called blackout period starts. The blackout period is a period in which Fed members are not allowed to give any speeches or any interviews related to monetary policy, with outlook to the upcoming rate decision of the Fed then on the 31st of July. And since the economic docket, the economic calendar is very, very thin in the week to come, and therefore let me just switch over here to the website from Admiral. And let me just guide you through this. This is probably very interesting. So admiralmarkets.com, there you go to analytics, and then you click on Forex calendar. This is what appears. And now what we will do is we will select the data, the date from next week on Monday until next week, Friday, 26th. And then we go here to filter. We take the high impact data sets. We check the boxes for the countries we are interested in. And then we click on apply filter. We close this. And as you can see here, the main event next week is surely the Thursday, Thursday, July 25th. It's the ECB rate decision, and everything else is very, 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 very thin. So we have some data from the US, durable goods. We have the GDP growth rate, which is probably seeing a better print due to some strong retail sales data, which published over the last days. Still, I'm a little skeptical if these data sets here can really trigger high volatility. So I'm very, very doubtful, to be honest, if this is possible. And yeah, if we look at the thin economic docket, and if we take into account this so-called a blackout period, then you can understand why I think it's very, very unlikely that big volatility will be triggered here in $JPY. And after these comments from Williams were put into perspective, in fact, nothing big changed, even though I have to say there's a tendency which underlines my my outlook for $JPY, which is lower. I think we haven't yet seen the bottom here, but I think we are very likely to see another attempt to break below 106.80 and then go for a retest of the flash crash lows here and the current yearly lows around 105. And let me just tell you why. So we have already seen the expectation in regards to the Fed Watch tool, and we have seen that so far it's slightly below 50% now, that market participants are expecting the Fed to cut rates by 50 basis points. And what is really interesting in this regard is if you look at the current 10-year US Treasury T-note, 10-year T-note yields, and they are stabilizing above 2% here. Why is that of interest? Because I think that markets are currently underpricing in the T-note future the likelihood of a 50 basis point rate cut, which means nothing more than if the Fed comes out with such a deep cut and it's still on the table and markets are playing it with 50% likelihood, then I think that it's not only a deep rate cut, but they will also adapt their outlook for further steps to be expected. And when looking at the Fed Watch tool, I won't open it now because it's obviously taking a little too much resources. But when you look at it and you click a little through it, you will find out that currently markets are only pricing four rate cuts for the second half of 2019 with a probability of something like 20-25% max. And if we get to see such a rate cut of 50 basis points, I think that there will be another cut in September by 25 basis points and also another one by 25 in December, which will add up to 4 rate cuts by 25 basis points each. And this is something I'm not yet seeing be priced here into the T-note future, in my opinion. I think that this would really catch the market on the wrong foot, and this could then trigger some significant US dollar weakness, which is likely to affect this currency pair, $JPY, in the most aggressive way, and then result in the push lower below 106.80, and then activating as a target on the downside the region around 105. Still, again, I'm not seeing big volatility to come here in the days to come. So in the upcoming week, I see subdued volatility in $JPY, and the same is true for gold, which went for a break above 1,440 USD, but didn't succeed yet, and is right now also trading back below that level again. So in fact, right now, I think that after these comments from Williams were put in perspective, this is a potential fake out on the upside in gold. And that said, I could imagine gold to drift lower from here and then probably trade again back into the region slightly above 1,400. So somewhere in the region around 1,410 probably on the downside, which means that there's probably some room for a corrective move lower of something like 2% here from the current highs. And any sequence of now on the lower time frames, let's for example go to the 50-minute chart. Any sequence here, falling highs and falling lows, is probably interesting from a risk-reward perspective to some extent. You have to understand it's a clear anti-cyclical trade. But if you plan to trade anti-cyclically, then things have to add up, and in addition to that, you get probably the right odds to trade against the trend in this regard. And I think this is currently given in gold after the comments yesterday, which obviously do not if we, and this is something we should do now, we shouldn't trust that this is true, that Williams did not intend to say something affecting, even though he failed miserably, but nevertheless, so he did not intend to give an idea of the dovishness, and especially in regards to the monetary policy approach from the Fed then. And so with this in mind, I could imagine gold then probably to drift lower here, to develop a structure of falling highs and falling lows. And then this is probably interesting for short-term traders, especially, to trade back gold, trade gold back into the region around 1,400. Even though midterm, I clearly stay bullish in gold, and I think that we have a very good chance to rather sooner than later reach the region around 1,480, 490 USD per ounce, respectively the region around 1,500. And probably even higher than that, depending on the dovishness of the Fed statement then. So that's it on gold, dollar JPY, DAX, EURUSD. Probably also something worth mentioning also here. Let's probably start with this. This is already playing out really well, and I could imagine this to keep on playing out well, especially if the dovishness from the ECB is delivered next week on Thursday. What is this? I mean, it's the Bund, obviously, okay, the Bund future, FGBL, but the question is, why is this red? And the explanation for that can be found in the traders block on the website from Admiral. Let me just close these tabs here, and then let's go here to the analytics tab again, and there to traders block. And one trade is already running. The other, AUDJPY, we will look at here in a few seconds. So probably, let me just open this tab first, and then let's scroll down a little, and there you can see, hopefully you can see it. It's sure. It's everything's right. So it's from the week before. So we made this already a topic here. There you can see it. It's from 10th of July. So last week on Tuesday, Wednesday, it was published here in the traders block section, and there you can see an explanation on the pattern itself, which played out over the last 21 years. So in 16 out of 21 years. FGBL gained in the window here between the 15th of July till the 12th of August. And it gained on average 183 ticks and dropped only 83. So, and the idea how to trade this can be found here. We entered the trade on July the 15th, and then we enter a stop, worst case stop in this in this regard. So based on the average range, or based on the max loss, which is very likely to be hit here in this regard. So the max loss was 183. There, no, I'm sorry, the max drawdown was 315, while the max loss was 176. So we placed a stop of 180 points in this case, or ticks in this case, and we add 183 here on the closing price on the 15th of July. And so now, if you look here, the closing price that was here, 172.35. Yes. So the target we have on the upside now can be found around 174.2. And currently we're trading at 173.50, 173.60. So the overall target of this trade can be found somewhere here in this region. And so far it looks quite good for the trade, since it's only 80 pips in this case. We have 80 pips to go on the upside, and the potential trigger could be delivered by the ECB next week. And so if you think this is interesting for the Bund, again, there's another seasonal pattern playing a role then here in Australian dollar JPY. Also, further details on the pattern itself can be found in the traders block section, and there's also the same explanation how to profit from that. So the interesting thing for this long trade is in fact that it's even though the RBA cut rates, it's a carry trade with a positive carry. So you're getting money for holding the position itself, which is something which is of interest and also very important to me. And in fact, because this is usually adding some, let's say, it adds some juice to the profitability of the setup. It's not said that it will play out. And we do not know whether we will gain on the trade or not, but still having such a yield advantage here is usually is something to consider in this context. So the time span is the 29th of July till the 27th of August. So it starts then not next week, but the week after on Monday. So there's enough time to prepare yourself and then to think how to probably adopt this idea how to trade the pattern based on your personal risk preferences and all this. And yeah, just I just say read through it. I just want to try to share it here in the chat box, the Q&A. Can I? Let me just see. Open. Okay, no, it's not. Okay, 1 second. Let me just see. Where can I? Yeah, that's not good. So somehow I can't find the tab where I can add the URL here, even though it's not very difficult to find. You just go to Analytics, Traders Block, and there you find the pattern somewhere at the top already because it was published on Wednesday. And yeah, just go through it. Feel free to also send your feedback, ask your questions, and that's it. In fact, from my end, I just hope that you enjoyed the weekly market outlook for this week, and we talk again to each other next week then on Friday, the 26th, then 1 day after the ECB, hopefully with some big news then from the ECB. To be honest,